All right, guys. Thanks again for everyone to jump on to this webinar today. We're excited to invite you on here so you can learn a little more about RV parks and the opportunity that the Wise Choice Fund is presenting. Again, my name is Kevin Nguyen. We have Shane Thompson and Brian Rice on the webinar as well. We're excited about going through this. So let's go ahead and get started. Before we start, I'm going to go over a quick disclaimer. It's a lot of words, but it's important for us to go through it real quick. This document has been prepared by Wise Choice Fund LP to provide selected parties with a preliminary understanding of the company. This document has been prepared based on publicly available information and certain confidential information as well. Wise Choice Fund LP, its related bodies, corporate and other affiliates, and their respective directors, employees, consultants, and agents make no representation or warranty as to the accuracy, completeness, timeliness, or reliability of the contents of this document. The company has provided certain non-GAAP and non-IFRS financial information as supplemental information regarding its operating results. Also, this document contains forward-looking statements which are identified by words such as believes, estimates, expects, targets, intends, may, will, would, could, or should, and other similar words that involve risks and uncertainties. Whoa, that was a lot, but we got through it. Let's go ahead and jump into the actual slides. Again, I want to welcome you all to our webinar. This is for investors who are exploring alternative real estate opportunity investments that they can invest their money in with a significant return potential. We wanted to say that RV parks present a distinctive opportunity that deserves consideration. It's a growing niche, and we're excited about getting you guys to invest in it. Just a quick table of contents of what we're going to go through. We're just going to talk a little about Shane and Brian, who they are, the problem when it comes to the current market, housing market, the solutions, who the Wise Choice Fund is, the different investment opportunities we have, going over some of the superior returns advantages of RV parks, why you should invest before the crowd, before everyone makes it so popular, just like how storage units were, the investment strategy and how it works, the depreciation benefits that you can gain from it, why Shane and Brian are even putting their own skin in the game, the examples of the investment performance, why you should work with Wise Choice, and the next steps to go move forward. So we'll go ahead and start with Brian first and get to know a little more about Brian.
All right, so I'm Brian. I'm also the fund manager, but beyond that, I'm a trust administrator. I've been doing real estate since 2009, and I bring my experience here to Wise Choice.
Awesome. Let's go ahead and talk a little more about Shane and get to know him.
Yeah, as Kevin said, I'm Shane Thompson. I work with Brian. I'm kind of like a co-fund manager with Brian, but I've been in real estate, about 10 years now. I took a little hiatus from real estate. Would have had some bad deals go through, but been back in it now for about 7 years. In addition to real estate, I also do stuff in business endeavors, but spend a lot of time raising capital and deploying capital in different assets, and particularly RV parks we're excited for because we find them to be a new niche class that is growing every year. We find it's recession proof, so we're excited to share that with other people and also, bring people back to the outdoors. So we look forward to talking more about ourselves, a little more about these investments and what we can do to give investors great opportunities in the future.
Awesome. Thanks for sharing a little about yourself, guys. Appreciate that. So let's go ahead and jump right into the problem right now. With what's going on in the housing market, there's just a lot of people facing high inflation, with groceries being more expensive, gas being more expensive, just everything in general being more expensive, especially housing as well. Housing prices have gone up, interest rates have gone up, and it's just going above sustainable levels. So there's just a shortage of affordable options out there when it comes to housing. There's a big gap between income and housing costs, and that has resulted in many individuals struggling to be able to find some housing needs that can fit their own budget. With the solution we have here that we're going to be explaining, we're going to be talking about how RV parks can provide that affordable housing solution that can help many people in the US today. There's lower upfront costs and flexible leases, so that it's able to meet these budgets that are more affordable for a lot of people in the US. That's more practical in being able to fit their budgets and helping them to have a better housing solution. There's different amenities that we provide, such as dog parks, laundry facilities, propane, firewood, ice, shower facilities, gift shops, and other things to help improve the overall living experience at the RV park. When it comes to RV parks, again, what I mentioned earlier is it is another affordable housing solution. It helps to provide a solution that's going to be able to help with the housing crisis right now, giving people another affordable living option, especially when it comes to comparing to apartment rents or renting a house. Those can be a lot more expensive. It helps to provide them with a way to cut costs and promote financial stability. Another thing that's important is the community impact as well when it comes to RV parks. These parks foster close knit communities, it enhances social connections. People just get together. It also helps to support local economies. It helps to grow the small businesses around as well and gives an upside when it comes to tourism benefiting the whole local area. Another thing that's important is it supports development as well. Just think, the more we get into the issues with the housing affordability, there's more RV parks that are being generated out there, and it's creating thriving environments that benefits not only the residents but the actual community itself. So let's go ahead and talk about who the Wise Choice Fund is. The Wise Choice Fund is a Wyoming limited partnership, and they are pleased to offer a distinctive investment opportunity focused on RV parks. It's This offering is available for accredited investors, providing them access to a niche market with a promising potential. So, if you're ready to learn more, hope you're getting excited about learning what RV parks can do when it comes to investment opportunities. All right, let's go ahead. You want to go in, Shane or Brian, talk about what the investment opportunities are when it comes to RV parks?
Yeah, Brian, how about you go ahead and I'll take the next one.
All right. So RV park acquisitions is something we're always doing. We're always looking at parks and looking to acquire good parks that we can improve and improve the value of the park. So that's where we have value add strategies. We look for parks that we can expand and improve the operations, increase the park's profitability and value. And we look for parks that have higher potential for returns, better returns, by leveraging their, better underwriting, better marketing, and better returns for the investors.
Yeah, so kind of piggybacking off of Brian here, you'll see kind of the potential RV parks offer, right? So we look at single family, multifamily, and RV parks. You can see there's quite a vast difference in returns. Going from single family up to an RV park, you can potentially see almost double the returns that you may see. And obviously in multifamily, we're still seeing, upwards of 50% to 80% higher returns. And that typically falls in line with, because we are treating RV parks similar to multifamily, multiple units in a single location, but our overhead is typically much lower because we don't have a huge huge concrete structure to build and deploy and sustain. We're really just, we're managing land, we're managing plots of land, and we're managing just basic utilities with those amenities we mentioned a few slides back, like dog parks or laundry facilities. So we're managing much smaller buildings, but we're still charging rent to a bunch of individuals on one contained space. But so instead of going vertical, we've gone horizontal, which allows us to capture a similar rate of return for rent, but decrease our expenses significantly, as well as reduce the costs associated with getting into an opportunity such as an RV park as opposed to a multifamily deal. And in this slide here, you're seeing 8 to 12% for single family and up to 10 to 20% on the park. The multifamily falls in the middle. And so there's always room for each of these to slide left or right, but you'll substantially see that RV parks routinely are 50 to 100% above multifamily or single family returns when underwritten and purchased correctly.
So just to piggyback off of what Shane just talked about, we just wanted to remind you guys again about the advantages of RV parks versus multifamily. I know a lot of investors out there like to invest into multifamily when they want to scale quicker and get out of the residential side. But some of the advantages when it comes to RV parks is number one is easier tenant management. They're having short term stays and they're paying in advance month to month. So who doesn't like that, getting paid up front? Another thing is less low maintenance costs. There's just minimal site upkeep, and it's very quick and inexpensive to get the infrastructure started, especially whenever these guys are acquiring RV parks and they're expanding. Another thing that's also an advantage when it comes to RV parks is just it's less competition out there. It's still a smaller niche, so not as many people are in there, and it requires special knowledge that Shane and Brian and other operators are putting in. So it helps to get them to get started, and they're able to work on getting these superior returns when it comes to working with you guys as investors.
I'm going to add off you real quick, Kevin. So adding on the competition aspect, I think on the last stats I saw was there's some like 5,400, 55,000 like transactions that occur from multifamily a year and conventional multifamily. And then like mobile home parks is like 640, and then RV parks is even less of that. So you can see that if we're, only a couple hundred RV parks move a year, whereas several thousand mobile homes move, and then it's like, 5 to 10,000 are moving in terms of multifamily. You can see that the competition is significantly less, and we're talking, maybe 90 to 80% less competition as opposed to what you see in conventional multifamily. And then obviously compared to single family, we're not in the same field. We're talking millions of sales versus a couple hundred every year.
So basically, you want to invest before the crowd. So we have an established industry. There's 77% of RV park owners have been in operation for the last 20 years. It's a growing demand where 13% of households plan to purchase an RV in the next 5 years. Consolidation opportunity, 79% of RV parks are individually owned by mom and pops, usually older couples in their late 60s and 70s. In the big picture, over $5 billion in revenue among RV parks and campgrounds with an expected growth of 4.59%. The number of parks, right now there's around 15,000 parks nationwide as of 2023, and it's growing every year.
Oh man, over 15,000 parks, that's a lot.
Yeah.
I feel like the storage units used to be so popular, but RV parks, they're growing.
For sure.
So go ahead, keep on moving forward, guys. And like I said, RV parks are the next best thing to storage units. It used to be storage units was the popular thing, and RV parks is still a small niche, but it is gaining popularity. And we want to let you know, like, hey, this is the next best thing right now. You should definitely consider investment opportunities when it comes to RV parks. So let's talk a little more about the investment strategy, guys.
Yeah, I'll tackle this one here, Brian. So we generally, our strategy is to acquire parks, and we usually do it by two means, right? It's either parks that our team may look for ourselves, or we're going to align ourselves with other experienced operators, and we're going to deploy capital and put those assets under management using them as a primary operator and us as the primary money partner, right? And usually when it comes to our people who are deploying capital to, aka those experienced operators, we're typically looking for them to have numerous parks under their belt, probably close to like 7 to 10 years of experience, showing already a track record of those parks. And we usually look at those parks to be acquired through a means of creative financing. Not always the case, but we do like creative financing, especially when we're using some seller notes. I mean, sometimes we heard people try to pitch sub twos, not successfully yet, but we have heard people trying to do those as well in parks. But creative notes, seller financing, sometimes people have offered in, buying into the park as a partnership, and then we grow the park with the owner, and then we buy them out in a future date. So there are a couple of different strategies, but we do look ideally for creative deals, but we're not limited creative deals. We will look at some conventional deals that are bought with SBA, other conventional lending, but predominantly we do prefer creative focus. And then the next step is once we get on our park, we try to stabilize it, right? So we're looking to either use marketing or some sort of a tactic where we're trying to increase the rent rates as well as the number of occupants who are on site at any one time. So usually we're going to buy a park. We're going to probably be in this like 50 to 60 range. We're at 56% occupancy, and our goal is to try to push it up another 15 to 20%. And then our goal is to typically increase those rents ideally. Usually within that first year or two, I'm seeing about 10 to 15% on average. And then we go into a more stable 2 to 3% growth year over year on that case. And then once we've stabilized the park, we typically look for a build out phase, right? So we've got the park, we've improved its initial value, it's creating cash flow already, we've improved the cash flow, but now the next step is we'd like to have the park have vacant land or adjacent land that we can then either acquire or expand on and look to double, triple, maybe quadruple the number of RV pads we have. And then we can use that to increase the value by not only increasing the number of pads, but also those pads will now be at a higher rental rate, and it'll increase our overall occupancy, which increases the exit strategy for this park, right? Because when we sell, it'll be worth more, which leads us to the next point. When we do sell, since we've built it out, we've in essence doubled to triple on average the number of pads. That gives us a much bigger exit multiple, and our equity will be significantly higher from our initial purchase price. So that allows us to buy the park, have it cash flow from day one, providing a nice conventional return. And then also when we sell it, we get a nice big chunk of money at the end because we've increased its value by increasing the size of the park.
Who doesn't like to get a chunk of money in the end, especially within the 5-year time frame? That's excellent. I'm sure everyone else will be excited about that.
Yeah, no, absolutely. That's where we look to see the biggest return, right? We have these nice, pretty stable returns during the holding phase of the parks, but when we sell, that's where you'll see like the biggest return on capital. Like, steady return, steady return, steady return. And then in the year we sell, you see this huge, 10x on your return.
Awesome. How about you explain a little more about the depreciation benefits, Brian? How that can help be an advantage for these investors who come in?
Yeah, definitely. So when you invest in the Wise Choice Fund, you can depreciate up to 75% of what you invested into the fund. So in 2024, it's 60%. It may change in the future, 2026. Right now, we can receive up to 75% of the depreciation benefits. So that's pretty cool.
So what Brian is saying, get in sooner than later, because the part of the perks of right, not only is it growth, but also depreciation. And unfortunately, the depreciation benefits are changing out of our control, but they may go up, may go down, but we know for certain that they are higher now than they may be next year. So the sooner we get in, the better we can get people's money deployed in parks and offer bigger depreciation this year.
You want to go ahead and jump in and tell us a little more about the minimum investments and how they can invest, Shane?
Yeah, absolutely. So we have 3 classes of investments on our fund, but the minimum is $50,000, and then our next class is $100,000, and then we go to $250,000 plus. And each of those has their own different returns and waterfalls. But as you see here, our minimum is $50,000 at an 8% preferred return with a 40-60 preferred equity split. So that's kind of like our minimum investment. So obviously, the more you invest in our case, the higher that return rate goes up, and that preferred equity split increases as well. So Class A here being the 50,000, Class B being 100,000, and then Class C being our larger investment of 250,000 or more. And when it comes to actually deploying capital, it doesn't always have to necessarily just be cash that you have in a savings account. It can also be, as you see, your money that we have in your 401ks, some sort of maybe self-directed IRA. As long as the funds are available from a source like that, we can deploy those as well without any tax concerns or burn. You can move them over without having any concerns in terms of fees or so forth. Most of these accounts will allow you, with some stipulations, right? We have to verify, but for the most part, most of these accounts allow you to take the money and invest it in a fund such as ours. And then I will say the last thing is, I just covered quite a bit, is the 1031 exchanges. We currently do not do 1031 exchanges, and it's sort of tricky in a fund to fund because we're not allocating directly to a single asset. But we are looking at ways to make that an option for us in the future. But as of current, we cannot accept 1031 exchanges.
So Brian, why don't you, I know Shane had talked a little about the different class members, but if you want to remind the investors again how the difference between the different classes A, B, and C.
Yeah, definitely. So as Shane said, in Class A, we have $50,000 minimum investment. You get 8% returns with quarterly distributions and 40% of the equity split when we sell the property. In Class B, you get a $100,000 minimum with 10% returns and 60% of the equity split when we sell the properties. And then in Class C, it's 250,000 minimum with 12% returns, and you get up to 80% of the equity split when we sell the properties. So it's pretty fair.
Yeah. And I'll add to Brian's case too. As I mentioned a few slides ago about how we sell for that big, 2 to 5x multiple based upon how much we grow the park. That's where you see that preferred equity split coming into play. And that's where you'll find the biggest difference in these different classes, right? Because the return rates are bigger, right? They are a couple percent, but that preferred equity makes a big difference. That's where someone in Class A or Class C may be able to see a magnitude of a 1 or 2 times the return because of that equity split. So it does make quite a difference. And that's where that exit strategy and that growth by development has a huge impact on the returns that we give our investors.
Awesome. Thanks for explaining that, guys. That's very appreciated. Let's go ahead and move forward. Can you tell us a little more, Shane, about what an accredited investor is? I know a lot of people sometimes they're like, I've heard about this word before, but I don't know if I am an accredited investor. How do I know if I can invest into the Wise Choice Fund?
Yeah, so obviously you guys can see here a little bit of the breakdown, but in essence, for most people, accredited investor usually represents an individual who makes at least 200,000 or 300,000 as a joint couple in the last 2, revolving years. And usually that's maybe coincided or adjacent with $1 million worth of assets. As you see, there's $1 million worth of assets. There's also another opportunity you see there, the professional certification or knowledge, which is the much less common pathway. I think, Brian, you may be able to try. I don't think I've ever met anyone who's ever pursued that route, but you can take some of the courses as listed here, proving financial wherewithal and knowledge. And there's a way for you to get around the accreditation in terms of financial means with having the knowledge for it. Don't know as much about it. We have not seen too many people come across that avenue. It has been discussed, but no one we've met has actually deployed that strategy. But it does exist. We put it out there for some people. So if you are maybe not fully hitting, you don't have a $250,000, maybe you have 50,000 to invest, but that's maybe the bulk of your income. If you can take the certification and improve that you have financial means to understand what you're getting into and have autonomy to make that decision well, we can take people in that situation. Otherwise, as I was saying, usually it's going to be 200,000 or more in annual income, and then usually it's combined with like $1 million worth of assets.
Awesome. Thank you for explaining that. I'm sure that clears up a lot of, it makes it a little more clear for investors out there who don't know about what a accredited investor is.
Absolutely. I will say though too, maybe Brian, you can chime in if you know a little bit more about it, but I believe there may be some changes coming to this, and I think those amounts may go up, but I don't have the exact date or time that may change. But I think I have heard that there may be a push to like 250 or 350 in the coming future, but it may be another few years off.
So that means they're interested. They should be jumping in here pretty soon.
Yeah, for sure.
Yeah. And I think that's predominantly predicated on like inflation and cost of living, right? The same 200K now is not the same 200K it was 10 years ago, and it's not the same it'll be in 10 years, right? So I think it'll slowly change, which makes sense just in terms of the cost of living. What 200,000 is not as cool as it was, I said a while ago, as it will be in the future either. So.
All right, Brian, let's go ahead and talk about the investment period, anticipated returns, and how the investments will be distributed to investors.
Sure thing. So the investment period, basically it's estimated to be 4 to 7 years. Basically, when you get in from when we sell the properties, that's your buyout opportunity to get basically your equity share in the properties. The anticipated returns, we anticipate to make basically 1.5 to 3.5 times what you put into the fund over 5 years. And then the distribution commencement. So given basically we have to stabilize every park that we usually take over, it's going to be usually the second quarter when you come in to the fund that you'll start getting distributions. And then the majority of your distributions and equity will be at years 2 through 4.
That sounds great. Appreciate you explaining that for us. Go ahead and move forward. So I wanted to talk about why investing with the Wise Choice Fund is important in my opinion, but also stating the fact is whenever you're picking a fund to invest with, you want to make sure that the operator has skin in the game. And as I have here on the slide, not only does Brian and Shane have skin in the game, they put 360,000 of their own capital to help acquire RV parks through their own fund. They're very confident in their fund working, and that shows there that they're putting their own money, not just a small amount. 360,000 is a lot of amount of money putting their own capital in. So if I were you, I'd find a fund that works and operates and shows that they have their own skin in the game, because you want to make sure that you're not just putting your own investments into something that someone might not feel as confident about. So let's talk a little more about the investment performance examples, guys.
I'll tackle this one quicker for you, Brian. So look at this right here, right? So we have K River and Ranger Park, which are two recent parks that we recently deployed on, and these are actually full disclosure. These are pro forma numbers, right? So we recently put these parks under assets under management. We did some underwriting with ourselves and with the operators, because these are not parks that we acquired. If you guys recall a few slides back, I said we also find parks, but we a lot of times in our fund we find other experienced operators and deploy our capital into their fund. So in this case, these are the numbers that they underwrote. We cross-represent it with our numbers, and we were able to feel very confident that the numbers made sense to us. But you see on these two parks here, what we just got very recently. I think Brian would chime in, but it's like maybe early this summer we deployed on them, and like now like they're officially closing like just a few weeks ago here. Mm-hmm. But you can see the returns are quite significant compared to what you see in most other deals, right? So for K River, the thing that draws my attention is the equity multiple, right? So 2.1x multiple. So that means if you were to invest 100,000, that you would walk away with 210,000 as like the average return for that. And then Ranger, even more impressively, being quite high, right? So if you put $100,000 into that deal, you would roughly walk away with 360,000 at the end of that deal. And that is over a 5-year hold term, right? You can see like the initial investments aren't too big too. So going back to me and Brian's previous slide about, having the 360,000 into a deal, that's roughly, between a third and a half for most of the deals we come across. But in this case here, you'll see the initial investment is 1.3, 1.7 was what the fund had to deploy into these. And you can see the IRR and those equity multiples are pretty significant. You typically will not see that kind of return in most single family, and very limited to ever see that in multifamily. But as it goes back to the original thing that it's raw land for the most part. You're just managing pads. So we have low buy-in, which is the source of the initial quality of return and high return, and then it's also low overhead. So with the low initial investment and the low maintenance and overhead, that's two things allow you to have a lot of freed up capital to offer big returns to people. So as you see there, we say 1.5 to 3, but 3.5. So it does vary from park to park, but for most part, you're going to see these 2 to 3 returns quite common for every dollar you put into the park, or into the fund, I should say, specifically. Anything to add to that, Brian?
No, but that's definitely. So you're going to get the equity multiple plus your distributions plus your principal that you put back into it.
It looks like we got some numbers here, Brian. Can you explain to us what we have on the screen?
Yes, this is for the Ranger RV Park. So we got year one. Basically, this is our short-term rentals, our long-term rentals, our pull-through, and our premium pull-through rentals. Our revenue, we have our total lot rent, and our total income is $696, $353,000. Year 5, we're expecting to make $1.4 million. So it has a lot of good returns, good potential there.
Yeah, it looks like over double the amount by year 5. So we definitely see the value growth.
Yeah, this is just kind of pulling the picture full circle. This is Ranger from the slide we just discussed, but this is kind of showing you a year-by-year breakdown. So if you go from that 6.96 to that 1.4, that's roughly that 2.1 multiple return you're seeing there. So that's how you get it done. Yeah. So that's just how you're seeing it spread out there. So you'll see that the returns sort of stack, right? So it's sort of stagnant, as Brian said, that like year 1, year 2 are sort of slow, but then after year 2 into year 3, year 4, those returns exponentially get faster and faster. So it may feel slow because that's when stability occurs, and that's when the build out starts to occur. But then in years 3, 4, and 5, that's where like all that money that's makes the park and makes the deal sweet occurs. So it is like a mild Agreed.
Awesome. It looks like we have some numbers here as well, Shane, and it kind of breaks down like the costs associated with running an RV.
Yeah, so it's just sort of a high level, right? We're still on using Ranger Park here, but we're just kind of showing the examples of the overheads here that may be involved in a park and the total capital required. So as you see, the expenses do grow, right? But they're not proportionate directly to the growth of the park, right? So I think for price, Ryan, if you can maybe correct me, is Ranger, was it around, is it 40 or 60 pads? And the goal is like, it's like 90 or 120 in this one, if I recall?
It's 60 pads right now, and it's supposed to be 135, I believe.
Okay. So yeah, so just recurring. So this park could be more than double, right? So the goal is to double its size before we exit. But you see it, the expenses don't double, right? The expenses only go up maybe about 50%. So the more we grow, there becomes a disproportionate gap in revenue and the expenses. So the park gets larger, expenses go up, but our income goes up by a larger amount. So that's how we start to see these big returns and big multiples when the park exits, because the expenses don't grow as significantly with each pad we grow. So you can see here over year returns in terms of expense growth. And you'll see that some grow, some stay fairly stable, but typically the ones that are going to be usually larger will be maybe like utility costs. Typically is our biggest cost associated with the park, because every pad is using water and electrical source. So usually our bigger overheads revolve around those, but otherwise most things only marginally go up. You don't even have to necessarily hire more staff. You can usually probably double a park and maybe you use the same staff you have, or maybe hire a part-time staff person. So even labor is a fairly fixed cost when it comes to growth of the park.
All right. It looks like we have here some more numbers, guys, and talking about the net operating income and how the debt comes into play.
Yes, this is the Ranger profit and loss. Basically, we're paying the LPs, which is the limited partners. That would be our investors. And we have our debt positions, our balloon, and our phase one construction, phase two. So basically, we're also paying ourselves back at the GP, general partner. So at the preferred equity, 8%, it's basically $136,000 a year, years 1 through 5. But the net operating income continues to grow. So that's a cool thing.
So, Shane, I know you had talked about the investment and returns again, but this kind of gives investors a little better picture of how their money will be working.
Yeah, so we're still focused here on Ranger as these slides move to an example. And this is a different iteration to see how those returns may look. But you can see there is a 1.7 was the initial capital deployed into this park. And you can see what that return looks like for $100,000 invested over that 5-year return. So you can see like the average quarterly distributions. You can see the cash flow. So the cash flow and quarterly distributions are typically associated with that preferred rate of return. And then as you move down, because I think, so in this case, 100K would be a 10% preferred return. And as you move down to the 5-year LP cash flow plus equity sale, that's where you'll see that big chunk of change coming, right? So you're seeing 42,000 of a modest cash flow during the holding phase, and when that park sells, this person in this case at 100,000 is now going to see another 150,000, $200,000 of cash and that equity split of a 60-40 split. So that's where the bulk of that money would come from. So, but at the end of the day, it's still good returns during the holding phase. And then when it sells, as I keep saying, that's where you see a huge surplus of capital. And then all said and done, in this case with Ranger, we were underwriting at about 3.59. So just shy of a 3.6 return on total capital from what invested. So said $100,000 invested in, get you almost $360,000 when the park sells.
So tell us, it looks like we have on screen here, Brian, just kind of a little more breakdown of year to year so that the investor can get a better idea of how much cash flow they'd be making.
So like on the, if you came in at 8%, you're at $100,000, you'd get about $8,000 in your first year. Actually, every year, 2 year 5. And then your cash flow would be around 4,200, 4,700, and then 12,000 on year 5. And then your total return would be around 458,000. That'd be your total invested plus your cash flow plus the sale of the park and your initial capital return.
That's a large number.
Yeah, it's pretty good.
It is pretty good. So going into the next slide, I'm pretty sure we have investors who are just thinking, why are these returns so high? You think you'd be able to help explain that to them, Shane?
Yeah, we can kind of make this one pretty quick. I think I've touched on it a few times, but the big thing is, right, there isn't a large structure to manage like you see in multifamily, so it's really just land costs, right? And then when it comes to expansion, you're just adding some gravel or concrete pads, which are usually very basic things to install, and then you're just running utilities, right? Water line, electrical line from what's already existing. You're just expanding it out to those new pads that if you build. And otherwise, the overhead's pretty low, right? You can usually run a good sized park, up to 100 pads, usually with a person and a half, maybe two people. And then, the park kind of runs itself, especially if you get a good community of people, they tend to self operate. So a lot of these things kind of require such low expenses and low overhead. And then just because, in addition, as a previous slides with like Ranger, the initial investment is so low as well, too, right? It doesn't take 20, 30, 40, $50 million get into a park, right? You can get into a park, of the size we focus, usually 1 to 3 million, and that can get you, 100, 200 pads. So like the low overhead mixed with the low initial investment combined with like the low maintenance, like all those things just have a lot of room for income without having to constantly redeploy into maintenance or expansion. And obviously, as you see here, using creative opportunity as well too. So we do a seller carry, or we're doing some sort of a unique buy-in, we're usually getting significantly lower rates than you get with a conventional loan or lending. So we may have debt servicing that's occurring at a fraction of the local current market rates. And then that's in conjunction with, low overhead. So these things all stack on each other and allow us to continuously decrease our bottom line in terms of expense ratios to our incomes. So that allows us to buy these small, modest-sized parks and then have a huge return on them.
That was a great explanation. I appreciate that, Shane. Definitely makes me so excited about hearing more about RV parks. I don't know about everyone else on this webinar, but it makes me excited. So you talked about all these numbers. It's great. We're able to get some explanations and examples of the returns for the investment. But let's go ahead and talk about why these investors should choose Wise Choice Funds, Brian.
Well, basically because we can offer superior returns than almost any other investment out there right now. We have tailored investment strategies. We use, integrity in our investments, a transparent, collaborative approach to build trust while, using our industry experience and networking to help capture profitable opportunities as well. So we're distinguished by our dedication to personalized service and precise attention to detail.
Yeah. I want to add that too, that, Brian also has some of his own parks that he manages as well. So he came to the fund with already some RV park experience. And then additionally, as I mentioned earlier, a lot of what we do with our fund, we're deploying on already experienced operators who have a track record of numerous parks that they've either owned and operated, or they also ideally have even gone full cycle and exited through like their own syndicates. So they have a track record of having understanding of how this all works, and that they're not, just sole operators, and they're not looking to be managers themselves. Most of them, these parks are underwritten so that they have professional management in place, and the operators are just kind of holding the ship together. So we look for those people and we partner with them. That gives us additional security. So it's not even just us you're trusting, you're also getting an opportunity to have other experienced individuals operate these parks, oversee these parks, underwrite these parks, and make sure things go together. So you're getting a team around the park selection and the park maintenance. So it's not even just us few on our team here at Wise Choice Fund. You are getting sometimes another 4 or 5, 6 individuals on these other parks who brought it to us. So you get a massive team of a handful or so more people who can manage parks and account for the best and the worst in each scenario.
Awesome. It's all about collaboration. That's how we're going to be able to move forward and get these awesome returns.
Definitely.
Absolutely.
Well, I appreciate you guys jumping in and giving more information, knowledge, showing your expertise and experience when it comes to RV parks. Thanks everyone again for jumping on this webinar. We really appreciate you taking the time out of your day to sit with us, getting to learn a little more about RV parks and why this is such a great opportunity to look into investing as you diversify your own portfolio. let's go ahead and talk about the next step. If you're an accredited investor and you'd love to hear some more information or you have questions, there's a QR code on the screen. We're going to go ahead and drop the link as well in the chat so that you're able to schedule a time that's convenient that you can reach out and have your questions answered, anything that you may have. Also, if you're interested, if we go to the next slide, we have a way for you to connect with us as well. We have the website there, Wise Choice Fund. You can follow us all on Instagram at Wise Choice Fund. You can follow Brian and Shane. The Instagram handles are there, along with me and Jennifer ourselves. Again, we have the QR code right there on the screen. If you'd like to reach out to get a little more information, you can scan that QR code, take a picture, and we'll also drop it in the chat as well. Just fill out the form. We'll get your information and we'll be reaching out. See if we could get you guys moving forward with this awesome RV park investment opportunities. Again, thank you again for everyone jumping on the call. We appreciate everyone spending the time with me, Shane, and Brian. Let's go ahead and see how we can collaborate together, guys.
Thanks.
It's been good. I appreciate it. We'll see you guys.
See you later.
All right.